Hello and welcome to Moving Iron Podcast Markets. I got Sean Hackett back here to talk about what's going on in the world of commodities. He's with Hackett Financial out of Boca Raton, Florida. Sean, how you doing today, buddy?
I'm doing good, raring up for another year. I'm excited. I think the multi-year bear market in grains is starting to turn, and I'm very optimistic about a much better outlook for the next few years, and that's going to be good for U.S. agriculture, despite um, obviously still some near-term headwinds with Trump
Sure.
and such forth and so on.
hmm
So,
Yep. So we had just kind of set the table a little bit. So you've been talking about this all year that you're like, we're going to see a large swing in what the USDA actually comes out and settles up with. You saw this in the October report where they made a big cut and November, December timeframes came through, and now we see this January report where they kind of settling up for the year. And we had a big turn in the overall markets. So if you look where they're at now, the corn market got shaved off by 3.8 bushels an acre, if I remember correctly. Um,
whoops,
yeah, a little bit off there,
whoops.
a little bit off. So that makes a big swing there. And then also same thing on the soybean side of the bean side. There was roughly, let's see, there was somewhere between the trade was expecting 3.2 billion bushels and it came in at 3.1 billion bushels. So um, a big swing there as well. So I guess Sean, as you're looking at this, um, we saw a huge correction come in just like you've been talking about. Um, we've got this kind of the best crop ever scenario like we always have every time something gets planted every year down in South America. Kind of that brewing, but like you've talked about there's plenty of issues down there as well. So I guess looking at this picture right now, Sean, as you take a look at where we're at now, moving into that first quarter of the year, going into planting season, which is just around the corner. How do you think the markets are going to stack up, and how do you see things continue to move over the next short-term window here as you look through it?
Well, the oversupply that we thought we had in grains is now no longer the case. We have adequate supplies in soybeans. I would argue we have on the tighter side in corn supplies now. That's a big difference in psychology. And that's so now we certainly have priced it in with corn almost having a 80 to 90 cent rally off of the August lows. And uh, we're certainly pricing some of that into a soybean price that everybody thought would be in the eights, now finding its way into the tens, right? So, um, so that pretty much, in my opinion, kind of takes the significant downside that everyone was worried about a few months back off the table due to fundamentals. Now we can have lower prices because the stock market crashes, or there's other factors, but
Sure.
based upon bustling oversupply of all time that everyone thought was in place. That's not reality. It was never reality, and now we know it's not reality, and the prices are reflecting that. We are just starting to harvest Brazil soybeans. The current consensus by the same people that were telling you that we were going to have a 190 yield on corn back in August are telling you that this is the biggest crop ever produced in Brazil, and for that matter, ever produced in the world. And that's not going to happen. When you look at the weather in Brazil, one thing that you have to understand is that we had a very, very dry planting season, which means that majority of the acres got planted in the back half, not the front half. We had some moisture in the middle between planting season and before pod setting began. And then we had very dry weather from late December into early January during pod setting. Now, we did not have a lot of heat. So we know that if we have very dry weather, some rainfall, but not a lot of heat, you can have a good crop, but not a great crop. We've seen this in the US repeatedly, you know, good but not great. Good but not great. So 175, 180 is great. My view is it's just going to be good. And the difference means instead of being 175 to 180, I'm thinking 160, give or take. 165, 150, somewhere in that 160 as a focal point is, I believe, where we're going to wind up with the reality of what yields could do when it's been this dry, but we don't have a lot of heat. It's not a terrible crop. They will have soybeans to sell. They will sell those soybeans, but it's not the bin buster, the biggest crop of all time. And that's a big difference in how the market views price levels and such forth and so on. So it's going to take a while, Casey. The USDA is not going to get ahead of this. They never do. CONAB probably is the first one that will start making some downward adjustments. January, there's some harvest data that starts to come in that make CONAB, the Brazilian version of the USDA, make some changes. I would be thinking that more likely the March CONAB report and the March USDA report, we might start seeing the trend start to lower production in Brazil. And like here, when you start lowering crop yields as harvest is going, small crops keep getting smaller. And then that's what I expect to see. By the time we get to June, we'll get to the right number. Of course, by June, we'll be talking about weather in the US and all kinds of other things, and no one will care anymore. But I think that's directionally where we're heading, is a smaller, good bean crop, but not this massive, largest crop of all time. It's virtually impossible, in my opinion, that we can have that kind of a crop with the type of deficient moisture that we had. If we had high heat, this could have been a major crop problem, but we didn't get that, and so that's where we're at. And
Yeah.
it's the same situation how everyone massively overestimated soybean and corn yields back in July and August of this year. Same thing's going to happen there. Obviously, with second crop corn, we got to plant it first in February. There's no way to really estimate that. My general feeling, Casey, with weather, La Nina has made a brief arrival. That's uh, creating some rainfall here in Mato Grosso for the month of January, and some dryness in Argentina and southern Brazil. But it's rapidly deteriorating. The Southern Oscillation Index is already negative, which is more El Nino-like. So we're going to move into February. We're going to get back into a neutral negative, but we're not going to be in La Nina. And it's a La Nina Mordecai, warm sea surface temperatures off the coast of South America. Whatever is cold is more in the center. We've talked about this before. And that leads to a much, much drier Mato Grosso, where 72% of all the second crop corn is produced. And the weather models are just grossly overestimating rainfall potential in that region for the next 3 months when you look at the long-term forecast. So there's going to be some issues with that. Nothing that's going to drive the market it's going to take until probably back half of March, but that's something to watch as we get into March. Remember, we already had a bad corn crop last year in Brazil. We could be looking at something maybe not as bad as last year, but still nowhere near where it needs to be to rebalance what is now a much tighter U.S. corn supply market.
Right. Okay. All right. So let's talk about a couple other things that are out there that I found to be very interesting. We haven't talked about it like we should have on the show, and that's my fault. We start looking at dairy market. Dairy market had a good rebound from the avian flu situation that was there, right? You saw this big drop off, kind of things rebounded, and we're still above 20 right now. So I got to go back and look to see where we finished at for the day. But where we're at dairy wise, it's not a bad spot, right? Comparatively to where everyone thought it was going to end up at. If you take a look at where things are at now, Sean, on the dairy side, what are your thoughts there? And are we kind of reestablishing this price here, or do you see somewhere in the future where there could be a big drop in dairy somewhere?
We had the initial run up on avian flu and the worries over that, and because it was impacting the Midwest for the most part, and Central West like Colorado and places. And then it looked like that was kind of calming down. We got our hands around it. The USDA said everything was fine. Of course, always subject to corrections later. And we had a correction, a pretty good one, like $2.50 down. And we had warned we might get one, and then all of a sudden California got it, and got it real bad, like worse than anybody else had gotten it. Now, California isn't the entire dairy industry, but they're an important dairy state. And so that the market got, oh no, all right, we're gonna run the market back up. So then we ran the market back up to 20 plus, and my feeling is that we're reaching peak California problem. Okay, seasonally, peak production in the U.S. occurs in the spring, meaning that's where we're seasonally based upon the lactation cycle of dairy cows in the U.S. That's when we produce the most milk in the year, and then it tails off from that point into the end of the year. That's the seasonal. So the problem I have with milk right now is we've had this secondary run up on California that I think that avian flu effect is peaking, and we're entering the seasonal upswing in production into the spring. Says to me another correction, not a crash, not like you know, but another correction like we had before, where you go from 2021 down to 17 and a half, 18. Uncomfortable correction, a correction that a dairy producer would not want to give away because that is they lose their margin. If they lose that, they lose the margin's gone and they're losing money again. So I'll say the last time that we had 2021, I'll say it again. This is a time for dairy producers to be, locking in second quarter milk prices. I think that this makes sense. It pencils out. If they did their job correctly and bought a bunch of cheap feed, which they should have, then they should be looking at a really good environment. And that's what I think they should do right now. Beyond that, though, higher grain prices that I see coming, higher feed prices that I see coming, and the avian flu isn't going away, Casey. As we learned anything from the poultry industry, once it enters, it never goes away. It'll come back, a different strain. Some years is worse, some years less. But we are going to be dealing with avian flu in the dairy industry now for the foreseeable future. So this problem isn't ever going to go away, but we're going to have periods of rallies on the next time we get a strain or the next time there's an issue. Like egg prices, they had a big spike a few years back, they crashed. Now they're spiking again because the avian flu's come back to the chicken produced the egg producing chickens. So you have to manage that as a producer. Right now, I would be looking to lock in cash sales, lock in prices in the second quarter, like we did it in the first quarter. The last time we were here before we corrected. So after that, I'm pretty constructive on dairy because once we start going on the cyclical downswing in U.S. dairy, and the avian flu continues to be around. Finally, by the way, the USDA said, "Oh yeah, we were just joking about production being fine. It really got clobbered, and we just wanted you to know that." And kind of like hogs for 24. Oh yeah, hog production's going to be huge. Nah, we're just joking. They're flat. All those billions of dollars of loss in history had, yeah, they kind of decided not to really invest and produce more. So that's our USDA. That's how they operate. Nonetheless, like the grains, they are coming closer to the truth, and it did create a nice rally. But you have to be optimistic. Trump's getting in office here shortly, whether we like it or not, depending on what side of the aisle you're at. He's going to be saying all kinds of things. His uh, cabinet are going to be saying all kinds of things. They'll be tweeting things at 4 in the morning. There's going to be a lot of ups and ups and downs and downs. And what does he mean? He changed his mind. I don't know what he means. So when the getting is good, and you got a good rally, and you got a bird in the hand, take it until we really know where Trump is going to go exactly. And it's going to take 6 months before I think we have a good handle on his general direction, even though that direction may be fraught with aberrant turns to the left and turns to the right. In 6 months, we'll have a pretty good trajectory where he's going for his presidency. Some things will mimic the last time, and some things won't. He's an unpredictable deal maker, and we have to expect that not everything is going to go exactly as it did last time. So,
yep. Okay. All right. A few more things that came out in the report today. Cotton's had its run. I mean, you've seen it get smacked around quite a bit here lately, and this report didn't help it out at all. The market was expecting 14.16 million bales, and they got 14.4. So it's a favorable report, but it still finished down quite a bit today by 149 points to 67.01, where it finished that for the week. So down about 65 points for the week. I guess, Sean, as you look at that with that level of favor, I mean, not with that big a spread, there's quite a few more bales out there than what they had anticipated by almost about 400,000 bales. So I guess as you're looking at that, how do you overcome that in the cotton market? And I mean, and obviously China is still kind of going through its ramp back up, and they're rebuilding their economy and whatnot, which that's a big play on the cotton market side of it. But I guess as you're looking at this, what's your thoughts there, and where do you see the cotton market going?
Well, demand's been disappointing. We've talked about it's been
Yeah,
a
we talked
demand
probably
problem.
about
They finally caved in and lowered the exports, which is really why the ending stocks in the U.S. rose. Not sure that was a terrible surprise. I mean, eventually they had to lower it. The problem is exports recently have been really, really good.
Mm-hmm.
So the USDA is supposed to be forward thinking. They're supposed to tell you what they think is going to happen and not tell you what has happened. So my way of looking at it, what they should have said 3 months ago was demand's not going to be very good for a while. Instead, they said it's going to be very good. Then they said, oh, it wasn't very good. So then they lowered the number telling you, well, it wasn't very good. What they should be telling you now is it's going to be much better 3 months from now, which means they're going to have to raise those export numbers back up to some extent, lowering the ending stocks. So it's kind of like they're in a rearview mirror. They're acting in, it's like the Federal Reserve. They act in a kind of a reactive instead of a proactive fashion. Even though we were down a dollar some today, it certainly wasn't a limit down move or anything. It's not like we broke support on the charts or anything. I think the cotton market is just going to is found a place that I think it's very comfortable to wait around until the Chinese stimulus provides enough confidence and consumer confidence by the Chinese citizen that those exports that we just started to see turning up now get them to raise the export numbers again. And I think that's what's going to happen. This is not a rip roaring off your face bull market. This is more of going to the upper 60s to the upper 70s. That's what we're talking about here. But the difference between upper 60s and upper 70s for a cotton producer means everything to whether you're able to cover everything with a little left over or not. And so
Mm-hmm.
um, I still don't feel much different about the cotton market as I have for quite some time. I feel we're in a basing pattern, a very quiet basing pattern. I feel the USDA is stuck in the past, and I think the demand's going to be much better 3 months from now and 6 months from now, and those ending stocks will fall not to like crazy tight levels, but they're going to fall like corn and like soybeans to tighter levels that support somewhat of a higher price, and that's what I'm expecting to see, and that's what I would expect to expect going into the spring. And on top of it, right now, based upon some of the rallies we've been seeing in corn and such, cotton probably loses a few more acres than it would like to lose. And so overall, I don't think this report changes anything. I still remain constructive of the market and still expect that we're going to find our way into the upper 70s at some point between now and the spring. And that is a point where producers need to, run and not walk to make sure they lock in a price like we've seen in dairy. Dairy has had an opportunity. Everybody's going to get a chance. Now the corn producer has a chance to sell a good price when they didn't have it. You're going to get opportunities. Today's not the day to sell cotton unless you absolutely positively have to, in my
Right
opinion.
on. Okay. All right. Lastly, let's talk a little bit about wheat. So we got wheat didn't fare so well. Wheat kind of came across down this today, 3.25 cents. Still around 5.30 3/4 where it finished out today. Reports out there, so you're seeing a wheat stocks in India are at all times low, for example, and you're seeing that some really strong wheat prices over there, but their rice stocks are at all time record highs. So as you look at the wheat to rice ratio, Sean, as you're looking at this, what are your thoughts there, and where do you see those two commodities that hinge so heavily on each other? How do you see those playing out here throughout the rest of the year?
Well, right now,
First quarter.
if you look at the U.S. rice price, I think we closed, let's see, we closed at 14 and change. Let's see. Yeah, 14, about 14 and a half. The wheat price is trading low to mid fives. Historically speaking, anytime that you have been at a 2.5 to 3 times price rice to wheat, uh, right now rice prices are high, okay, relative to wheat. Everybody tries to do everything they can to consume more wheat and less rice until and that's where the price spread is right now. I mean, even though uh, India has large stocks from a good crop, the price is still high, um, because they haven't been selling a lot. They didn't say they're going to sell. They're going to give some ability to sell some, but overall, the rice market in Asia and in the Western Hemisphere, supply and demand is very, very tight. So that says to me that the wheat price is too cheap and the rice price is too high. So normally, when you have two markets that are at the wrong at these junctures, they're going to meet in the middle somewhere. The wheat price is going to rally, and the rice price is going to correct, and they're going to get the price ratio back to a more comfortable, 2 to 1, something like that, is where 1.8 to 1 uh, is typically where the balance is between the two. And so that's kind of what I'm anticipating. The wheat price is grossly undervalued, in my opinion, based upon the fundamentals. It's being kept here on the idea that the ruble has crashed. And because it's crashed, even though Russia is exporting substantially less than a year ago, and even though their ending stocks are down 25% from a year ago at the same time, the Russian ruble price hasn't gone up because the ruble is crashing, taking the punch bowl away. And that's the insidious nature of currency and translational effect. So, but that's temporary, right? That's temporary. If I'm right that the US dollar is going to make a major important top here in January, that would mean the ruble rallies, the Brazilian real rallies, all these things are important for agriculture. And that would start to make the Russian wheat price go up in US dollar lens. And that would allow for the extremely pregnant shorts, speculative shorts in the wheat market to decide that maybe they need to lower that extreme short position and take some chips off the table. That's where I think we're at. Obviously, there's no real catalyst weather-wise until you get post-dormancy in March. Last year, we had a major frost in Russia, Ukraine that put $2.50 onto the wheat price. Our work says that a positive quasi-biennial oscillation and a neutral to neutral negative ENSO 3.4, whenever we've had that rare combination, it has been a higher order elevated risk for spring frost in both the U.S. winter wheat belt and in Russia-Ukraine winter wheat belt. So no way to know which one does over the other. If they both do it, last year it was Russia, not the U.S. Nonetheless, those are catalysts that are clear, they're defined, and and you know it's we're at a decade support level at current prices, meaning you have to go back a decade, and we're at a level that that is supported from a decade of trading. Doesn't mean it can't go lower, but decade support levels usually aren't a bad place to be thinking about a bottom in a market most of the time. And so I would look at that, and I would look at a record short position by speculators, and I would look at some of the most bullish global stocks to usage ratios and exporter hands, including um, India's record low wheat stocks. And I would say there's a lot of risks to the upside. They haven't materialized yet, but if I'm sitting here with all of that information and I'm a risk manager, buying physical wheat, protecting the wheat price here as an end user, as a user of wheat, this is a clear thing that one ought to be thinking right now in the wheat market, and the corn market taking off to the upside only supports that even further, because at some point we're actually getting like KC wheat prices are getting actually almost competitive with corn feed when you run the ratios. It's not too far away, and history says livestock producers will do the switch if that starts to happen. So there's a governor under the market here that says, yeah, we go a little lower, but come on, guys. you know, you
Right.
got a beach ball and you're trying to keep it under the water in a pool. You can for a little while, but ultimately it slips through your fingers and it pops back up. That's where I think the wheat market is right now.
Gotcha. Okay. All right. One more thing. Well, actually, two more things. If you look at the cattle hog market, they had a great week this week. Man, they were on fire. This report, which you would thought would have swung things the other way just because of the way grain prices shot up, you didn't see that happen. You actually saw a very strong finish to the week. So I guess as you're looking at cattle markets and hog markets both, what are your thoughts there?
I mean, especially the cattle market, we're breaking out of this 1 year long wedge pattern, continuation wedge pattern. We've talked about this pattern before. The way a technical wedge pattern is that you look at how much the market moved going into the wedge, and then if it breaks out of the wedge, you assume the same rally is going to occur once it breaks above wedge resistance, which in this case is 190 spot price live cattle. We had a $30 to $40 rise into the wedge. This is just technicals. This doesn't mean it's definitely going to happen. I'm just saying this is what you do and try to how these patterns operate. That you would then say, okay, well, there's a potential for 30 to 40 cents on the 190. That's your upside target based on how a technical wedge continuation pattern tends to go. Not every time. Sometimes it could fall short or go more, but that's the general pattern that we're looking at. And if we had a strong weekly close and we broke spot price out over the wedge, then it wouldn't be like out of the question to say we could put 30 or 40 cents onto the 190 or see something like 220, 230 live cattle. That's just what the technical pattern says is possible. You obviously have to be diligent when the price is this high and the profits on the farm as a cattleman are this good. You know how long do you want to stare a gift horse in the mouth? Just be careful. Just be careful. If it were me, you know, the government subsidizes a program called LRP, and
Right.
you're able to utilize LRP as kind of a discounted put option that the government subsidizes. It still leaves your top side open, still allows you to participate if this technical pattern plays out the way it oftentimes does, but it also protects you in case the stock market's looking shaky. Maybe it drops almost at 2,000 points and for no reason, and the cattle market gets spooked and it starts to crash. Anything can happen in this world, Casey. If it were me, I would layer in some LRP on this breakout to lock in an incredible margin on the cattle ranch and see if this 30 or 40 cent technical pattern upside materializes, and then go sell the cash. That's how I would handle it. So
Right on. Okay. All right. Lastly, you've talked a lot about planting problems. You talked a little bit about today, early season frost concerning the wheat market. But is that when there's early season frost in the wheat market, that means that there's early season planting frost during planting season, right? So you got that situation going on.
yeah,
Talk a little bit about how you see that playing out here through March.
well, the biggest issue is really, if your soils are not 45 degrees or warmer, corn planting is not going to get done.
Right.
You're not going to do that. And so it really comes down to how long do those temperatures stay at 45 degrees or less on a sustainable basis to delay the corn producer from going in there and getting the crop in the ground. Um, like I said, I mean, uh, the way we are structured price wise if you look at the corn soybean ratio, we are geared for a big planting number on corn versus soybeans as it stands today. Like 95 million or more, I think, is what many are going to suggest that we might plant if all goes well. So it's very important that if to knock that number down a little, um, so that we have a better opportunity for weather problems this growing season to create more upside than where we're at right now. And so that to me is what you'd want to look for. But obviously, as we learned last year, if the wheat market takes off on a Russia Ukraine or on a U.S. winter wheat frost post dormancy killing frost, we could put a lot of premium on the wheat market very, very quickly. And the wheat and the corn market and the soybean market both rallied strongly last spring to that. Actually, I think it was the highest prices for the year was that spring rally in wheat that got all the speculators to pile into corn and soybeans. So there's a lot of moving pieces. It's not necessarily that a frost in the spring necessarily is detrimental necessarily to yield because it's so early, but it could be psychologically important to higher prices if wheat really catches damage like it did last year, and it could slow down or alter a very, very high corn acreage number, providing more fuel for upside if we have a more drought-ridden growing season like we think we're going to have this year. So all that's part of the mix right now. My feeling is we're probably near a short-term top in corn, just because the speculator is piled in. We're near $5 resistance on the July contract. I don't think we're going to get the crop any smaller, or we're not going to get the ending stocks any smaller. I think this is the right number, and it just seems to me like we've got ourselves to where the price level is probably overdone it on a short-term basis to what the reality is on the long-term picture. And of course, with a very strong dollar that I think is going to roll over, but until such time that it does, it runs the risk that these prices have overshot themselves to the upside relative to what other countries can sell their corn and soybeans for. So,
right on. Okay. Well, Sean, good stuff as usual. Folks want to reach out to you and get more information about what you're doing at Hackett Financial. What's the best way to do that?
Our website is Hackett, Hackett, advisors.com. We also have a Twitter page at Faradex11. Also have a LinkedIn page. As I try to remind you and everyone else, I don't sit here on a computer all day long putting tweet after tweet after tweet. I put a few things out there from time to time on interviews and things to kind of give a broader picture of our climate work and our price forecasting work to see if how we look at our unique variables and statistics, cycles, and correlations might be of value to those who listen and watch your great show.
I appreciate that, Sean. Thank you for being a part of this. We had a great 2024. We had a bit of a hiatus there. You were on vacation. I was on vacation, and here we are back together now and looking to another big 2025. So this is going to be, I've always said from the equipment guy standpoint, me is that if you can have $4.75 to $5.25 corn, that kind of paints the picture to where you're not getting rich, right? There's no one out there just swimming in cash by any means, but there's enough there to keep the ecosystem kind of balanced, right? Input costs stay where they need to stay at. Equipment prices stay where they need to stay at. Used equipment moves like it's supposed to. New equipment moves like it's supposed to. Everything just kind of just like a harmonious balance.
There's enough lubrication in the system to keep things moving. Absolutely. And compared to what we were heard about, a piston
$2.75 corn.
I mean, compared to what was being said, this is a great result. Fantastic result. And if I'm even half right about what I think the next 2 years are going to be about, this won't be the end of the recovery in the ag economy, but it's a start. So,
right on. Okay. Well, Sean, appreciate you being the podcast, man.
Thanks, Casey. Always a blast. Hand in hand and heart to heart. Can't wait to see what 25 brings. So.
Right on, man. Right on, buddy. We'll catch you next time. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, X, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast. Check out TikTok over at the Moving Iron Podcast and see the YouTube channel, which is the Moving Iron Podcast YouTube channel. And you can see all that there. So with that, I'm Casey Seymour with Sean Hackett. Let's go move some iron, folks. Out.